Welcome back to Investing Talk Podcast.
Today we're looking at Strive.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For anyone tracking this company, the story of Strive right now is it's just defined by something absolutely wild. A massive, almost absurd corporate pivot.
It really is.
You have to understand, they were essentially a social media tech player a very short time ago, and now they're positioning themselves as a full-blown Bitcoin treasury corporation specializing in asset management.
That is the ultimate head-scratcher.
Yeah.
It's not just, a small strategic shift. It feels like they completely junked their old playbook and decided to start a whole new business from scratch.
Right. Using their public shell to hold Bitcoin and manage assets. It is the definition of a high-risk, high-reward move.
And we can see just how aggressive they are with this new identity, right? I mean, look at the recent corporate actions.
Exactly. They completed that really pivotal merger back in September 2025 with asset entities, which was a huge structural step. But they are not slowing down at all.
No. They're actively pursuing a proposed buyout of Semler Scientific. When you see a company go from social media to Bitcoin, and then start merging with other entities so quickly.
Including Semler, which is mainly known for medical diagnostics.
Right. You realize this is less about organic growth and more about, rapidly building a platform, or maybe just acquiring cash and assets.
It's defining their new aggressive strategy, and frankly, it also defines the massive execution risk involved.
So what's fascinating, and what sort of validates this strategy, is how they're funding it all. They just completed a preferred stock offering, that SATA product, raising about $160 million.
And this wasn't just your standard capital raise, was it?
And not even close. That offering was reportedly hugely popular, about twice oversubscribed for that first product.
And that tells you something really important. Despite the volatility, despite this insane pivot, there is real, concentrated institutional appetite for this specific thing, a publicly traded Bitcoin treasury.
And that fresh capital, it's not just sitting on the sidelines.
No, it's being actively deployed, primarily to acquire Bitcoin and, support those general operations during this hugely expensive transition.
Okay, that brings us to the balance sheet, because this is where the picture gets really interesting. It shows a kind of resilience you might not expect.
Absolutely. If you look at liquidity, which is so key during a transition like this, their quick ratio is very high. It's sitting between 4.4 and 4.7.
And for you, the listener, what that means is for every dollar they owe in the short term, they have almost $4.50 in quick cash to cover it. That's a massive buffer.
A massive buffer. Plus, their working capital is strong at $2.16 million. So they can handle short-term crises pretty easily.
And to just hammer home that financial flexibility, the company has effectively zero debt. They're sitting on a huge pile of cash with practically nothing hanging over their head. We're looking at a reported debt-to-equity ratio of 0%.
This isn't just good. It means they're completely independent of, say, market tightening or more interest rate hikes. They've got the funds to execute their vision.
It's the definition of a fortress balance sheet, really, built to weather this exact kind of storm. So they have the war chest, but here comes the unavoidable dark side of the analysis.
And financial challenges.
Right. Despite that incredible liquidity, profitability isn't just a question mark. It's a giant, blinking neon sign of concern. Revenue is modest, reported recently at about $633,000?
Staggering is the right word for the costs, though. Look at the net profit margins. They are deeply negative, hovering around negative 475%.
Which means they're burning almost $5 for every $1 of revenue they generate.
Exactly. And the EBIT margin is near negative 996%. It sounds shocking, but it just shows the immense scale of the financial fire they've started.
We do need context for those losses, though. This isn't just, a routine operating loss.
No, this is strategic hemorrhaging. These large losses, like the $266.46 million net loss in a recent quarter, are directly driven by the aggressive restructuring and heavy investment.
They're just pouring money into their Bitcoin treasury platforms, integrating acquisitions.
Precisely. And this raises that big question. Why are investors still interested if profitability is so far off? It's because the market is pricing in the vision, not the current reality.
So that high price-to-sales ratio, it's really a measure of that execution risk.
The market isn't valuing their current $600,000 in sales. They're pricing in the potential success of the whole Bitcoin strategy, which is a massive high-stakes gamble.
And if we connect this to the bigger picture, The tolerance for that loss really comes down to their perceived competitive edge.
They're leveraging an innovation edge in the finance tech space, specifically through rapid deployment of AI and their unique position as a public Bitcoin treasury entity.
And that strategic advantage, it's reflected in one incredible figure we found.
The 100% gross margin on their digital platform, that's exceptional.
100%. That is almost unheard of outside of pure software.
Yeah.
How is that even possible?
It says a lot about their model. In digital asset management, if your cost of goods sold is basically zero, you can maintain that margin. It reflects real pricing power and, the potential for incredible scalability once they hit their stride.
So that 100% margin, it kind of validates the tech, even if the rest of the company's still burning cash.
Exactly.
Okay, so that's critical. But let's shift to the technicals, because the stock's action really reflects all this risk and opportunity. It has been extremely volatile.
Which is no surprise, given the transformation. Its 52-week range is huge. It's run from a low of about 33 cents all the way up to $13.42.
That's a roller coaster. And the current price, sitting around $1.02 in late November, shows it's kind of consolidating after the merger.
We're seeing a real tug of war here. Looking at the chart, we can see key price levels. There's strong support noted near 80 cents and a dollar. The market seems determined not to let it fall much lower.
And on the upside.
The key resistance levels are clustered around $1.40 and $1.75. So for tactical investors, a breakout above that range could target $2, maybe even $2.50.
But technically, they are facing some serious headwinds, aren't they?
Oh, yeah. The stock is currently trading well below both its medium and long-term moving averages. It's below the 50-day, which is up near $2.46, and way below the 200-day at $3.13.
So the price action is basically saying, we don't trust the news story yet.
It's a classic show-me story from the market. That said, there is a little silver lining in the technicals.
The momentum indicator.
Right. The RSI is sitting at 37.76, and the MACD is also hinting at oversold conditions. So if a strong catalyst appears, the setup is there for a sharp reversal.
Okay, but we have to talk about the extreme risk factor here. You have to look at the beta. The stock has an ultra-high beta of 17.4.
17.4. That's not a stock. That's a guided missile.
I mean, is there any universe where that number is sustainable for a serious company?
It just reflects the binary nature of the bet. It means if the overall market moves 1%, this stock is mathematically expected to move 17% in the same direction.
So for you, the investor, it means this is great for short-term trading, but you need an extremely high-risk tolerance to hold it long-term.
Prepare for massive swings.
Given that volatility, investors are laser-focused on near-term catalysts. The next 3 months are critical. The single biggest event is the Q4 2025 earnings report, expected around December 15th.
That report is huge. It will give us the first full financial picture of the combined company post-merger. Everyone is waiting to see how the new Bitcoin Treasury unit is performing.
It's the first real audit of the new vision.
It is. And beyond earnings, there are other market events that could cause a lot of movement. There's an ETF rebalancing window expected in early January 2026.
Right. If Strive gets added or removed from certain indexes, that can have a big impact on trading volumes.
And then we're expecting major institutional buy disclosures around late January, which could signal growing confidence in the strategy.
And of course, the market is buzzing with rumors.
Always. One big piece of chatter is the company expanding its Bitcoin holdings even further.
I wouldn't be surprised they have the balance sheet to do it.
Exactly. There's also speculation about them upsizing that really successful SATA product to raise even more capital. And finally, ongoing talk about strategic partnerships with a major crypto exchange.
Okay, let's quickly summarize the primary risks you need to keep in mind here.
First and foremost, those persistent deep net losses. If that burn rate continues, it's going to scare long-term investors away.
And second,
the high execution risk. They're trying to integrate multiple very diverse acquisitions, a social media piece, a fintech firm, and potentially a medical device company. That's an integration headache of epic proportions.
So if we pull all this together, what's the overall outlook?
It's complex, it's volatile, but it's undeniably compelling. You've got a strong, debt-free balance sheet, an innovation edge in AI and Bitcoin, and a packed schedule of catalysts. It creates significant asymmetric upside potential.
The ultimate high-risk, high-reward scenario. And the strong balance sheet means they're not going anywhere. But the losses mean they're on a very tight clock to prove the new strategy works.
That's the whole story. The biggest question for Strive isn't survival given its cash position. The question is whether its bold Bitcoin-centric strategy will deliver the promised structural growth and finally pivot those deeply negative margins into profitability in 2026.
Don't miss our next analysis. Be sure to subscribe for all the latest insights.